Traders, have you ever experienced losses using a fair value gap, FVG, trading strategy, even though you can identify these gaps? I have faced this issue numerous times, until I realized the need to discern between ordinary and high-quality fair value gaps. In today's video, we will delve into various types of candlestick fair value gaps, exploring the psychology behind them and the price actions associated with each. We will cover everything from the basics to more advanced concepts. Moreover, we will break down the essential criteria and rules that can transform a fair value gap into a profitable trade. So, let's dive in. Let's look at market sentiment and its influence. Before we examine the features of fair value gaps in detail, it's crucial to understand market sentiment and know the main factor that drives the market, and the major psychology behind movement of the market. The driving forces behind market movements can be broken down into two key factors. 1. Liquidity zones. The market perpetually seeks to sweep liquidity to generate momentum. Liquidity acts like a fuel in the market, playing a crucial role in market dynamics. 2. Fair value gaps. The market shows a tendency to fill and rebalance the gaps within it. Consider this example: the price sharply drops, creating inefficiency and leaving behind a fair value gap. Later on, the price moves back up, filling the fair value gap and clearing out external liquidity before reversing, filling the most recent fair value gap. This cyclical behavior highlights the market's mechanism of clearing liquidity and filling fair value gaps. So how do you identify fair value gaps? To identify fair value gaps from a candlestick perspective, note the following. 1. Fair value gaps typically form within a sequence of 3 candles and are noticeable on the chart as large candles. The gap exists where the upper and lower wicks of adjacent candles do not fully overlap the body of the middle candle, creating a fair value gap zone between the wicks, centered on the body of the middle candle. 2. An exception arises with a 4-candle sequence to identify a valid fair value gap, if the first candle in a 3 sequence is an inside bar, forming within the preceding mother candle. In such cases, analyze the 4-candle sequence to identify a valid fair value gap zone. Neglecting the mother candle in such scenarios leads to incorrect gap identification. For instance, let's concentrate on this 3-candlestick sequence to identify a fair value gap. Without considering the red candle, the identified fair value gap will be incorrect. These principles apply to both bullish and bearish markets across various time frames and price action-based charts. Let's now focus on the theory behind fair value gaps. Let's consider this 3-candle bullish sequence that created a significant market imbalance that occurred on higher time frame. To analyze this 3-candle sequence from market structure view, let's go to lower time frame. You can see price forms a bullish structure. I can tell the market has filled the gaps present within it. This big momentum push to the upside was driven by high buying pressure and a lack of sellers in the market. When traders encounter such big movement and miss a buying opportunity, traders often place buy limit orders below key zones, like order blocks and demand areas, hoping for a pullback that activates their orders. This accumulation creates a significant liquidity pool, often swept by the market within the fair value gap. So, traders' fair value gaps are filled with pending buy or sell orders, acting as magnets for price. The presence of these orders within the gap leads to price returning to fill the gaps and continuing its momentum. In a downtrend, a fair value gap is often referred to as a liquidity gap that arises from the lack of buying pressure during a specific downward movement. The identification of such a gap relies on analyzing the impulse up or impulse down candlestick and its adjacent candles. Other candles outside this range are not considered in determining the gap. These liquidity voids are crucial because they can act as significant entry points, given the market's tendency to seek out liquidity. When the price trends downward, it often targets potential liquidity zones above it. Consequently, these zones become areas where the price may temporarily push upwards to fill the gaps before resuming the bearish trend. As we grasp the psychology behind fair value gaps, let's explore how to leverage them to anticipate future market movements and trends. A crucial factor for determining price direction is observing the price action within a fair value gap. If the price respects the fair value gap and exhibits rejection toward the upside, it indicates that the price will likely move upward to target the most recent buy-side liquidity, which is accumulated above the recent high. Conversely, if the price shows no significant reaction upon entering the fair value gap, it suggests that the price is more likely to move downward, aiming for the sell-side liquidity accumulated below the recent low. Now, let's have practical application of identifying and using fair value gaps using our real charts so that we can understand fair value gaps well. In a bullish scenario, consider a sequence of bullish candles, as depicted. Start your analysis from the bottom of a series of bullish candles. Identify a 3-candle sequence represented by this 3 green candles by drawing lines from the upper wick of the first candle and the lower wick of the third candle. We see a gap. Continue the process through subsequent candle sequences to spot additional gaps. In bullish scenarios, the price often returns to fill identified gaps before continuing upward momentum. Where is our next fair value gap? By drawing lines from the upper wick of this bearish candle to the lower wick of the following green candle, we can identify another fair value gap created between these candles. Moving slightly higher, there is another 3-candle sequence. However, drawing lines again reveals no gap between the candles, indicating no fair value gap. Now, if we consider these 3 candles and draw a line from the upper wick of the first candle to the lower wick of the last candle, we observe a gap between them. This gap is mitigated and rebalanced by these 2 candles. Further up, we encounter another 3-candle sequence. Drawing a line here identifies another unmitigated fair value gap. In this bullish candle series, we have identified 2 unmitigated fair value gaps, one located at the top and one at the extreme. The price attempts to push down once again to fill the liquidity voids in these fair value gaps before continuing its bullish momentum. Price could reverse from the upper fair value gaps or push lower to mitigate the fair value gap at the extreme. Both scenarios are possible in the market. The same concepts can be applied to the bearish scenario. Now, let's have a breakdown on a real chart analysis and see how we can use the fair value gap concepts in market structure mapping. Let's analyze the euro to US dollar 1-hour chart. Here, the price has pushed downward, breaking the previous major low and closing below it. This confirms a valid break of structure. Next, let's identify potential fair value gaps resulting from the recent bearish momentum. In a bearish market, it's crucial to analyze the chart from top to bottom to identify fair value gaps, while in a bullish market, the analysis proceeds from bottom to top. Starting from this high point, we begin our analysis. At the market extreme, we encounter a 3-candle sequence. By drawing lines from the lower wick of the first candle to the upper wick of the third candle, we identify a distinct unmitigated fair value gap at this extreme point. Upon closer examination, there is no additional fair value gap within this internal bearish impulse move. Now, observe the inside bar that formed just before the price created inefficiency in the market with this large momentum candle. In such cases, identifying a fair value gap requires analyzing a 4-candle sequence instead of a 3-candle sequence to highlight a valid and optimized zone. Therefore, we draw lines from the lowest point of the mother candle to the upper wick of the 4th candle to highlight the valid fair value gap. However, this fair value gap has been mitigated by the price, so it cannot be considered a trading opportunity. Within this bearish impulse movement, we identified 2 fair value gaps, one mitigated by price action and one unmitigated at the extreme. As previously discussed, prices are likely to return to fill and rebalance the gaps before resuming their primary trend. Therefore, we should wait for the price to retrace upward to fill the remaining gaps before continuing with bearish momentum. Let's see what happened next. As observed, the price pushed back up, filled the fair value gap, reversed direction, and resumed its bearish momentum. Essential criteria and rules for trading fair value gaps. To effectively trade fair value gaps, adhere to the following rules. 1. Break of structure. Ensure the price leads to a break of structure or a change of character in the market before considering fair value gaps for trades. 2. Zone consideration. In bearish markets, focus on fair value gaps in premium zones for short positions. In bullish markets, target gaps in discount areas for long positions. 3. Market extremes. Prioritize fair value gaps at market extremes over those found elsewhere. 4. Unmitigated gaps. Only consider unmitigated fair value gaps for trades. Once mitigated, a gap should no longer be a focus area for trading opportunities. This brings us to the end of this video. Let me hope you have learned something. Stay tuned for more insights in our next video.